Hello, everyone, and welcome back. Today, we are deep diving into a company that has been making significant waves in the Indian industrial landscape, Venus Pipes and Tubes Limited. Since its listing in 2022, this stock has transformed from a quiet small-cap player into a high-growth contender in the stainless steel pipes and tube segment. In an era where Make in India is not just a slogan, but a structural shift, Venus Pipes has positioned itself at the epicenter of the specialty steel revolution. But is the current valuation sustainable, or is the best of the growth already priced in? Over the next 13 minutes, we will break down the business model, the massive capacity expansions, and the financial metrics that every serious investor needs to track before making a move. What sets Venus apart is its laser focus on stainless steel. Unlike many peers who dabble in carbon steel, Venus specializes in high-margin SS products. Their portfolio is broadly divided into two categories: seamless pipes and welded pipes. Seamless pipes, which command higher margins and are used in high-pressure environments like power plants and refineries, are the crown jewel of their portfolio. The company has been aggressively shifting its product mix towards these high-value items. By focusing on critical applications where quality is non-negotiable, Venus has built a sticky customer base across sectors like fertilizers, food processing, and chemicals, effectively insulating itself from the volatility of generic steel commodities. Numbers don't lie, and in the case of Venus Pipes, the growth trajectory is exceptional. Over the last few years, the company has maintained a revenue CAGR of over 30%. But the real story is in the EBITDA and PAT margins. As they scaled their operations and shifted towards higher-value seamless pipes, their operational efficiency improved drastically. In the recent fiscal years, we've seen their margins expand as they optimized raw material sourcing and reduced logistics costs. Their return on equity, ROE, and return on capital employed, ROCE, are both comfortably above the 20% mark, which is a hallmark of a capital-efficient business. This financial discipline is exactly what institutional investors look for in a mid-cap growth story. A company can only grow as fast as its capacity allows. Venus recognized this early and embarked on an ambitious CapEx journey. They recently tripled their capacity for seamless pipes, which is a major game changer. But it's not just about more machines, it's about being smarter. Venus has invested in backward integration by setting up its own piercing mill. This allows them to convert hollow pipes from mother pipes in-house, significantly reducing their reliance on imported raw materials and protecting their margins from global supply chain shocks. This transition from a processor to an integrated manufacturer is the primary reason why analysts are bullish on their long-term cost leadership. Venus Pipes is sailing with very strong winds in its favor. Firstly, the Indian government's anti-dumping duties on Chinese stainless steel pipes have provided a massive level playing field for domestic players. Secondly, the global China Plus One strategy is pushing international buyers to source from reliable Indian manufacturers. Furthermore, the domestic push through the PLI, Production Linked Incentive Scheme for specialty steel, is a huge catalyst. With massive infrastructure spending in the union budget, particularly in green hydrogen, ethanol blending, and oil exploration, the demand for high-quality SS pipes is set to explode. Venus is perfectly positioned to capture this demand shift from unorganized players to organized, quality-conscious brands. Consistency is key in the B2B industrial space. Venus has successfully built a diversified client base, meaning they aren't reliant on just one or two big names. From Adani and Reliance to Tata Projects and Bell, their client list reads like a who's who of Indian industry. They have an extensive dealer network spanning across India, ensuring that even smaller requirements in Tier 2 and Tier 3 cities are met. Their operational excellence is further evidenced by their quality certifications, which allow them to export to regulated markets in Europe and the Middle East. By maintaining high inventory turnover and a lean working capital cycle, they have managed to stay agile even during market downturns. No investment is without risk, and Venus Pipes is no exception. The most significant risk is the volatility of raw material prices, specifically nickel and chrome, which are the primary components of stainless steel. Any sharp spike in global prices can squeeze margins if the company cannot pass on the costs immediately. Secondly, while the anti-dumping duty is a boon,
Any change in government policy or trade agreements could invite competition from low-cost imports again. Furthermore, the company is in a high-growth phase, which requires constant capital. Any delays in their expansion projects or a slowdown in the capital expenditure of their end-user industries, like chemicals or oil and gas, could lead to underutilization of their new capacities.
In conclusion, Venus Pipes and Tubes represents a classic growth at a reasonable price story in the Indian industrial sector. They have successfully transitioned from a small player to a formidable mid-cap contender with integrated manufacturing. The combination of favorable government policies, a shift towards high-margin products, and a robust order book makes them a stock to watch. However, investors should keep a close eye on their quarterly margin consistency and the progress of their international export expansion. As India marches towards becoming a global manufacturing hub, companies like Venus that prioritize quality and capacity will likely be the primary beneficiaries. Remember, always consult your financial advisor before making any investment decisions. What are your thoughts on Venus Pipes? Let us know in the comments below.